Let's consider scenario A, where you start a business by buying inventory worth 80,000 and you sell all that inventory in a month for 100,000. So the profit margin is 20%, which is nothing but the profit of 20,000 divided by 100,000, which is sales. Now consider scenario B, where you start a business by buying inventory worth 80,000, but this time you sell all your inventory for 90,000 in just 10 days. And then you buy another lot of 80,000 inventory and sell it again for 90,000 in 10 days. With 10 more days left in the month, you repeat this cycle once again. So in the month, your sales are 270,000, which is nothing but 90,000 multiplied by 3 cycles. Your inventory purchases for the month are 240,000, which is 80,000 multiplied by 3 cycles. 270,000 minus 240,000 means a profit of 30,000. And 30,000 divided by 270,000 gives us a profit margin of around 11%. So in scenario A, the profit margin is 20%, and in scenario B, the profit margin is 11%. Now the question is, which scenario is better, scenario A or scenario B? On the surface, scenario A may seem better because of its higher profit margin. But there is another metric you should note before deciding which scenario is better. That's return on investment, or ROI, which is calculated by dividing profit by the initial investment you made while starting your business. So in scenario A, the ROI is 25%, whereas the ROI in scenario B is 37.50. Look, profit margin is a transaction level metric. It's like saying how much do we keep from each transaction, whereas ROI is a business level metric, much better than profit margin, which is like saying how well do we recycle and grow the money invested. So, scenario B gave us the maximum return on our initial investment of 80,000. That's why it's a better scenario. The faster and often you recycle cash through the business, the higher will be the ROI. This recycling is measured using the cash conversion cycle, or CCC. It's all about the velocity at which your cash tied in the inventory is converted into sales and then finally into cash once again. The cash conversion cycle is calculated by adding inventory outstanding days and receivables outstanding days and deducting payable outstanding days. Inventory outstanding days is how long inventories lie idle before being sold. It's calculated by dividing average inventory by cost of goods sold and multiplying the result by 365. Receivable outstanding days is how long it takes to collect cash from customers. It's calculated by dividing average receivables by credit sales and multiplying the result by 365. Payables outstanding days is how long it takes to pay suppliers. It's calculated by dividing average payables by cost of goods sold and multiplying the result by 365. Let's calculate the cash conversion cycle of a business using an example. Assume the credit sales, which are sales for which money is yet to be received, for the year are 400,000. Cost of goods sold is 300,000. Inventory at the start of the year is 50,000. Inventory at the end of the year is 70,000. So the average inventory for the year is 60,000. Now we can easily calculate inventory outstanding days by dividing 60,000 by 300,000 and multiplying the result by 365. That's 73 days. Similarly, you can calculate receivables outstanding days by dividing average receivables for the year by credit sale for the year and multiplying the result by 365. That comes as 41 days. Similarly, you can calculate payable outstanding days by dividing average payable by cost of goods sold and multiplying the result by 365. That's 40 days. So the cash conversion cycle in this example is 73 days. plus 41 days minus 40 days. That's 74 days. So we can say it takes 74 days to convert cash invested in inventory into cash collected from customers after adjusting for time taken to pay suppliers.